It's Leanne. I'm a CPA, and on this channel, we talk about the emotions and the math as it comes to your money. And today, I want to talk about the Bank of Canada, who held rates at 2.25%. I want to talk about what it means for you as someone who is building wealth. Before we get into it, I got to give you this disclaimer that this is for educational purposes. It is not to discuss your specific financial situation, where you might consider instead engaging a qualified professional who can work through your specific situation. What does actually holding rates mean? So, the Bank of Canada is in charge of setting the overnight rate. This is the rate to which banks can lend back and forth to each other. But the bank's focus is in setting that rate is to keep inflation between 1 and 3%, which 2% being the sweet spot. So, if it's trending higher or lower than 2%, they are either going to cut or increase rates. Now, the Bank of Canada sets rates over different times during the year, but the last 9 times they set rates between June 2024 and October 2025, they went from 5% to 2.25%. Essentially, the overnight rate has stayed at 2.25% since October 2025. The last five opportunities that they had, they've chosen to keep rates steady. What are some of the factors that they looked at into keeping rates steady? The first one is inflation. When we look at inflation over the last period, it has come in at 2.8%. So trending above that ideal 2% rate. So, two things are driving this rate increase. The first one is higher energy prices, which we'll talk about a little bit later. And the second one is as a result of the elimination of the carbon tax. Because the carbon tax was eliminated 12 months ago, it will actually show up as higher inflation for these next 12 months. That's the way statistics are calculated, not actually anything fundamental that has changed in the economy. And if we actually eliminate energy prices and food to get to what is called core inflation, that rate has actually right around target at 2.1%. Inflation overall hasn't moved too far off the target rate. The next factor that the Bank of Canada considered was jobs. Essentially, what is the unemployment rate? And that rate was trending at 6.6%. Although that number might seem a little bit high, it essentially means that the employment rate hasn't actually changed for the first 6 months of the year. Jobs are essentially flat, which means that we have a stagnant job market. When people are not fully employed, they tend to spend less, which then has a knock on effect when it comes to inflation. The next factor that the Bank of Canada looked at was GDP, or gross domestic product. P represents the total value of Canada's goods and service. It's one of the broad based measures that the Bank of Canada can use to see overall how an economy is doing. And in Q1 2026, Canada's GDP dipped by 0.1%. Consumer spending grew by 1.4, but this was tempered by government spending, which actually fell. Housing activity also declined, and business investment stayed weak. Exports also dropped, while imports rose, as some folks chose the opportunity to rebuild their inventories. So, even though we did have a dip, the Bank of Canada is actually seeing that they think there will be some recoveries in Q2. Although the economy overall will be running lower, there is room for the economy to grow before overheating. The next area that the Bank of Canada looked at was US Canada trade policies. The problem is with the volume and the speed of changes, there hasn't really been a model that could factor in these changes on how it will actually impact the economy, and then therefore how rates should be set. So, as the US administration continues to propose new tariffs and changes in trade policy, the uncertainty is looming large. And uncertainty means that businesses are likely to spend less, businesses are likely not to hire. And it also means a general slowing down of activity. And this hesitation is actually showing up in weak GDP and weak employment numbers. The Bank of Canada can't really cut rates anymore or cut them aggressively if they don't know how this trade uncertainty is going to play out and therefore how it is going to impact inflation going forward. So, again, they're taking a wait and see approach. The next area to think about is the conflict in the SWANA region, or essentially over the Strait of Hormuz. This conflict in the SWANA region is largely over oil, which has resulted in significant increases in those prices and disruptions in the global supply chain. It impacts us here in Canada based on that global price. The Bank of Canada hasn't factored in higher prices into a lot of their models. They're actually waiting out to play and see what is the impact of higher oil prices. If you have debt, and particularly variable rate debt, so that can mean a mortgage, a line of credit, a HELOC, home equity line of credit. This rate pause means that your rate that you're paying, and in most instances, the payments that you're paying have not changed. But don't use this as an opportunity to sit back and relax. You can actually use this moment of stability to put more towards your payments. And if you can do that, your payments are going straight to principal, which will reduce the amount of time it takes to pay down that debt. The second impact is if you have a lot of dollars in your savings. Again, this is a big pause by the Bank of Canada, which means those rates are not likely to change. And therefore, maybe take this as an opportunity to make sure that your cash is being used effectively. Is there an opportunity to look around to maybe get a better rate, even if it is for a short term period? So, what matters here is that you have a plan for your cash and making sure that you are using it in the most effective way possible. When it comes to investing, Bank of Canada holding rates doesn't really matter too much on your long term investing strategy. You are still going to invest in low cost index funds, ETFs that are diversified so that you are getting the benefit of long term investing and growing your money. What it means if you are a mortgage holder who is approaching a renewal or someone who is going to be getting a mortgage, this is the time not to rest on your laurels if you're within 6 to 12 months of renewal and shop around. Don't just go with your bank, talk to a mortgage broker, talk to the banks that the mortgage broker doesn't talk to in order to get the best rate. And for my first gen people out there who are supporting more than just themselves, make sure that rate actually encompasses all of your obligations that you can carry. So you're not just considering the rate in your determination. We are going to take a deep breath and make sure that we are applying strategy. And that means knowing your numbers, knowing the impact on what this rate change has on your debt, what this rate change has on your cash, and what this might mean in terms of a renewal date for your mortgage or a rate if you are about to acquire a mortgage. Now, I hope what I've shared with you is impactful for you. I've been able to let you know what this rate change means for you. Share this with someone in your life you think could benefit from an understanding of what the Bank of Canada rate means for them.